AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines.
Bay Area real estate and mortgage experts with over 25 years in the business.
Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome into the Real Estate Report. I'm Tony Mendez.
And it's me, the maestro, Gordon Hines.
Maestro of mortgages. I like it. Good. Thanks for joining us today. You can always call the show, 800-516-1220, 800-516-1220, or email the show, Tony or Gordon at BayAreaLoanSource.com. Stories about, or the show's about real estate. It's about mortgages. We're going to hit both today. We do appreciate all the emails we get. We're going to probably get to a couple of them later in the show. In the meantime, mortgage rates continue to be the story again, in just a kind of a slightly different way. Several months ago, let's go back to March, we were looking at rising interest rates, and we didn't know if they were going to kind of stop. And then COVID kind of reemerged as a big-time player in our economy, and now we're seeing rates come back down. And then on top of that, Gordon, the Federal Housing Finance Agency, they got rid of that adverse market fee of 0.5%. It's actually in points, not in rate, but 0.5 in fees, which is helping a lot of people and helping mortgage rates drop down to some lows we haven't seen since last year. 2.8% on the 30-year fixed, according to Freddie Mac Weekly Survey, the 15-year at 2.1%, the 5-year ARM at 2.45%. Throw that one away. You don't need that if you can get 30-year fixed and 15 years in these ranges. And, of course, that rate's going to go up and down based on your equity, based on your credit score. You're taking cash out. Is it investment property? Is it a duplex or triplex or fourplex? And so there's a lot of factors that go into averaging this rate. But you can't deny that this interest rate environment that we've had over the last couple of years is really helping people do a lot of nice creative things with their financing.
Well, that adverse fee is a very, very important piece to our pricing, what we call price on the street. As we always talk on the show, rates don't change. What changes is the cost of the rate. So what that means is every rate now costs a half a point less than it did before since we took out the adverse fee, which is a good piece as far as pricing is concerned. So technically, the cost of rates have come down, which means now systematically rates have actually come down if you're judging it from a rate consciousness rather than the cost. So that's what the important piece about that half a point going away, no longer cost to the consumer. So now it's a better off for the consumer as far as pricing is concerned on the street.
Black Knight Financial, they say in their report that as many as 14.1 million borrowers could save an average of $286 per month. Those are what they say homeowners that are in what they call their sweet spot or in the money. Last year, in 2020, the average savings per year for a refinance was $2,800, according to Black Knight. So there's still a lot of people out there that consider refinancing. What I found interesting is that there was another incredible fact here that came out of this survey. You're going to get blown away by this. 27% of current mortgage owners, people own a house, they have a mortgage, 27% of them don't even know what their current interest rate is.
Well, we talk on the show all the time. We have the serial refinances. The people that refinance all the time because they're always in tune. They're always listening to rate changes. They're looking at ways of saving money. They look at ways to take money out of their properties. And there are some people out there just buy a property, just let it sit. Whatever the rate they have, they pay that loan off to its duration and never really consider refinance simply because it's an arduous task. So a lot of times when you look at the pendulum swings where the people that refinance a lot, and that's what a lot of people out there that don't refinance kind of sit on the fence and watch the rates go up and down.
Well, I think what we're trying to say here is that the rates are there to help you. And that's why the Fed has their low interest rates. That's why we're in a low interest rate environment. That's why the 10-year yield can't go much higher right now based on current economic conditions. That's why the Fed's trying to, induce inflation to try to get everybody back on their feet equally. And it's not really working out equally, but we're seeing investors raking tons of money in rents and taking savings away from renters to get into properties. We're going to talk a little bit about what kind of the two extremes of what's happening in the investment market, maybe three extremes in that fact later on in the show. But the story here is that interest rates are available for people to refinance. And if you're just sitting back and you don't know what your interest rate is, at least go look at it. then find out what you can get and look at the payments. Look what you can save. What do you do with the money that you save? That's something else too, Gordon. A lot of people don't. They save money, but they don't put it in the right place.
Well, cost of money is an inducement to save money. When we talk on the show all the time, is the biggest investment one is ever going to make is in their property. Rather it's residential or rather it's a rental property. So if as rates go up and down, you have a chance to once again benefit from that fact by refinancing, either by saving a cost, meaning lower the payment, or taking cash out and maintaining the same payment. So that is a benefit. It's part of money management. It should be part of anybody's portfolio to manage the rate that they're paying for how long, the terms and conditions based upon family lifestyle and conditions of life.
So right in the middle of this low interest rate environment, we've seen a couple milestones that have been made throughout the last couple of years when it comes to guidelines and new products coming back. For last year at this time, we were just scraping together to try to find what they call non-qualified mortgage loans, so kind of the near miss Fannie Mae and Freddie Mac conventional loans. Those finally came back. Now we're looking at some more guidelines pop up. What do you think of this one? Is this one too aggressive? A lender came out there today and said, you can do 100% cash out on a VA loan. That's 100% of your value. Do you think that's too aggressive? Now, I know there's some eligible VA borrowers out there that are going to say, I want that. But isn't that a little too aggressive?
No, of course not. For a veteran, a person that have dedicated their life to serving the country, some of it lost limbs, lost lives, lost family members. I don't think anything is too aggressive when it comes to a veteran. It's a specific program targeted for a specific group of people for benefit of the cost of service they pay for the country. No, of course not. I don't think it's too aggressive.
But we aren't going to see other programs like this. In fact, we did see earlier in the year, or was it late last year, we saw FHA cut back on how much you can do cash out. And VA actually did that. And I personally think it's a nice thing to see. Now, I don't think I would take out 100% of my equity in my house, but that's what led up to, one of the things that led up to the crash that we saw 10 years ago, and that was riskier products, stated income products, 100% financing. I even heard one there was 100% financing plus you can roll in your closing cost loans. Do you remember those? Yeah. I don't know if I would do that necessarily because, that puts you in a pretty highly leveraged position. I just think financially I would stick away unless you're looking at some sort of debt consolidation where you can manage that mortgage payment and you can get rid of some other debt that's just been dragging along and keeping you from saving money.
Well, once again, money management is should be part of your portfolio. The mortgage management should be the biggest part of your portfolio. You're looking at rates less than 3%, you're talking about 100% cash out. As long as the benefit outweigh the cost, then it's something you should actually look at. Could be a great cost saving. You might need to pay for college education. You might need to do something that's your only option is your primary residence. And if you can afford it and it's properly managed, I'm all for it.
Well, again, there are some of these new updates as we go through, and Gordon, you always talk about products and how they drive the industry. This is a smaller part of the whole overall products that are available going, FHA and then your conventional and then your jumbo. But it's been nice to see that jumbo is really coming around. That part of the industry has really helped a lot of people. You look at some of the statistics about what's happened over the last few years as far as the percentages of what people are getting as far as loan amounts. We've been seeing, if I can dig this up somewhere, we've been seeing the average loan amount, I believe, is $346,000 in the United States right now, where last year it was $326,000. So we're seeing the average loan amount go up. We're also seeing over $700,000 loan amounts. That went up 55%. So people are borrowing a lot more money because of the low interest rates. And once you get into that jumbo territory, and I think that's one of the reasons we did see that huge jump in the 700 plus mortgages that we're seeing, because the rates and guidelines have really started becoming a lot more favorable towards, high quality borrowers, great credit, great assets, and, solid incomes.
Well, if you look at the Fannie Mae and Freddie Mac rules of loan limits, every year for the last 10 years, Fannie Mae and Freddie Mac has increased their loan limits based upon the market conditions. So if conversely, mortgage, FHA, VA, Fannie Mae, Freddie Mac's all the same. The jumbo product is a product that are above those loan limits. As the market goes up, we're seeing appreciation in every market across the country. So conversely, you should see jumbo rates become more competitive because more people now are falling outside of the box of the loan limits, Fannie Mae, Freddie Mac, moving into the jumbo market. If you don't have a product to support that business, you will see that hinge on the market somewhere down the line.
One of the transactions we're doing right now is what they call delayed financing. That's a product that doesn't really get talked about that much, but in this kind of market where people are buying houses in cash, a lot of people don't like to use all of their cash. They want some of it back. Delayed financing is where you can buy a house in cash. It almost doesn't matter how much, because we do have a jumbo product that allows that as well, to replenish your money right away. In fact, you can buy a house the next day. You can come back and put cash back in your pocket as long as it's your money that you put in. That's and so for a purchaser, and they're looking at their retirement, you can take more money out now, and maybe it's some stocks or something. You can just go back and put that money back in as soon as possible, so you don't miss out on any kind of growth.
Well, in a competitive market where we're seeing right now, of course, we've been seeing competitiveness in the real estate market for the last year and a half. Cash offers get the nod, as we talked before, even though a cash offer is still the same as a finance product, but people for some reason think the cash is king. So if you can make an offer in a cash position, pay all cash for it and come back and refinance it, what we call
right away,
refinance, and replenish your cash. That's a very, very great competitive edge in the marketplace if you're trying to become the sole winner of a property in a competitive bid market where we're seeing 3, 4, 5, 6, 7, 8 offers, seller going with the highest offer, of course, but giving more favorability to the cash offer because you can close in 10 days, and of course, cash is king.
Would you refinance if you've had your loan for a couple of years at, let's say, 3 1/8, right? And now you can get that, your value's gone up a little bit, your LTV is a little bit better, your credit score may have improved. Would you refinance from like 3 1/8 down to like 2.65, 2.625? Would you do that kind of move?
Absolutely. It pays dividends, but it depends if you plan on being in the property long term. As long as you're going to stay in that loan that you refinance to exceed the cost at the time of that cost of that loan.
That payback period.
Of course, it's a benefit to you. All those factors have to come into place. Very important to stay on top of your game by managing your financial affairs, staying on top of your housing costs and benefits.
We're here to answer your questions, take your emails, and get your calls on the air. 800-516-1220, 800-516-1220, or you can email the show, Tony or Gordon at BayAreaLoanSource.com. Thanks for joining us today. We'll be right back after this break here on AM 1220 KDOW. I'm Tony Mendes. That's Gordon Hines. This is the Real Estate Report.
Questions about real estate? Call the program, 800-516-1220. Now, back to the Real Estate Report on AM 1220 KDOW.
About your past.
What are the 5 mortgage trends to watch in the near future? Rising rates. I think that one is, I think we're going to see that push out a little bit further until this COVID thing, these variants kind of really figure themselves out and we start really seeing inflation. Strict qualification. Lending standards seem to tighten a little bit during COVID. I agree with that. Yet we are seeing some guidelines open up, but you still have strict qualifications. Any comment on that one, Gordon?
Well, I mean, COVID it looks like it's reoccurring again. So I think the guidelines that were loosened up probably would tighten back up again, simply because it looks like we're experiencing an overflow of something that we didn't think was going to come back. So I think the market's in for another change. The market is full of changes. I think it's in for another change within the next 3 months regarding COVID rates and everything else we are concerned.
The average W-2 employee with, a couple $100,000 in assets to put down, or they have a couple hundred, 20, 30, 40% in equity with a good credit score, they don't really have to worry about changes in guidelines because that's been pretty standard across the board. It's the little ones, like how do they do rental income? What are the, can you use departing property rents in order to help qualify and things like that. Self-employed people really, that we see more in self-employed and bonus trends and bonus and the way they do kind of incomes like that. I think, but when we talk about strict guidelines, that equates into something that's a benefit. And the general public doesn't really understand. I don't know if they really understand this. I don't do surveys or anything, but strict guidelines equals low interest rates. The farther you get away from strict guidelines, the higher your rates go. And there are products that can have looser guidelines. You have the bank statement products. You have the DSCR, the debt service ratio product. But those rates are higher. So strict guidelines equals low interest rates. Strict guidelines means you can sell mortgage-backed securities at AAA, quadruple A paper and get investors to take smaller amounts of yields and profits because it's a better paper file. And in return, it goes back to the borrowers as a lower interest rate. So strict guidelines means low interest rates.
Well, the market's based on risk. That's what we call it, risk-based pricing. Products are priced based on risk. The higher your credit score, the lower payment or rate you're going to get. The lower the LTV, the lower the lower the rate you're going to get, because all based on risk base. So if you want to take more risk, if you do a no income product, that's going to more risk for the investor. So they're going to charge you a higher premium in order for them to give you that loan.
That also brings up the privatization of mortgages, the privatization of Fannie Mae and Freddie Mac. Break it up, let banks compete, and maybe that's in my book, that might be the only thing that really helps, is that you will see a big difference. You might see more tiers. Okay, I'm an 800 credit score, and I'm going to get a better rate than the 760 credit score. Right now, it's everything over 740. Until you get to jumbo, there's a whole different scale for jumbo. But that's all private. So you have these jumbo lenders saying if you have an 800 credit score or plus, you're going to get a better rate than if you have a 740 credit score. So that's all in the private market. So there are some proponents that say that this is the way we need to go, and it can create stricter guidelines for the better rate. So we're already following that philosophy, but I think this should generalize into just a few amount of products. The 30-year fixed is at 20% LTV with a credit score of 740. Everyone higher than that gets the same rate, right? Same pricing. So you privatize that, you get stricter guidelines going across the board. You might actually see it might incentivize people to actually start working on their credit as opposed to going, I can just use FHA with a 640 credit score and get a decent interest rate. Oh, by the way, I can have a higher debt ratio. Meanwhile, you can have a better credit score, more assets, a lower debt ratio, and you're going to get a better rate if you go. It's the way it works now. I'm just saying that might be the future of how strict guidelines work and how banks are going to compete with each other.
Well, strict guidelines are always controlled by market forces. As the market changes, so does guidelines. Of course, the more lucrative the market becomes, the stricter the guidelines become, the more challenging it is. You reduce your guidelines, but you raise your rates because you want to keep the competitiveness of the demand in for the marketplace, because the market actually works on products realistically, not on rates. Like conversely, right now, we're getting a lot of, last couple of weeks, we're getting a lot of people asking about 20-year mortgages who are in 30 years, can't quite go to the 15-year term, but they want to go to the 20-year term because, once again, I think people are better consumers now. They're managing their finances a lot more efficiently than they were before, and they understand the economics and numbers, understand they got on a 20-year mortgage, you got 10 years less of payments for 120 months. It could be a great financial windfall for you, especially if that's your only asset. Most people have one property, and I think it's your only asset to pay it off sooner, become an equity position, and that's for the future when you get to retire. Reduce your housing expense, which is the biggest expense you have typically in a household budget.
And this is something that's not taught in school either, unfortunately. You might learn the math, but maybe not the philosophy behind managing your mortgage. And it really is the biggest, practically, it could be your biggest decision you ever make other than having children, which costs a lot, by the way. But let me move forward. Other mortgage trends to watch, larger mortgages. We talked about that last segment. And I was wrong. The average record-setting mortgage today is $374,000 as opposed to 2 years earlier at $332,000. So we're seeing people take out more mortgages. Obviously, home prices are going up, and everything over $766,000 loan amount, $766,000. That jumped year over year, 55%. So again, going back to jumbos, we're seeing jumbos really with the they're competing again with that margin between conforming and high balance, not high balance, but jumbo, and we're seeing that margin shrink as far as rate. More non-bank lending, and this kind of goes back to my scenario here. Some of the largest banks in the United States used to compose, the five largest used to compose 50% of all origination. Wells Fargo, Bank of America, JP Morgan Chase, U.S. Bancorp, and Citicorp. They comprise only 21% of total mortgages last year. That's a decline from 50% back in 2011. What's your explanation about that?
Well, as we talked many times on the show, we say a lot of things a lot of times because it's actually factual. A lot of these bigger banks now had moved away from the small lending and wanted to move what they call wealth management. By moving to wealth management, they don't want to fool around with the clients in the 620 to 600 credit scores. They want the clients with this 800 credit scores like you have that have $2 million to make, because they want to manage their portfolio. So they figure it's more profitable to do that. So conversely, I believe they moved away. They left a lot of business on the table. We get a lot of that business that they don't want. So conversely, they're cherry picking right now because it's a very, very good market to cherry pick. And I think think as the market pendulum swings again, you might see them come back in and start picking up more products simply to kind of maintain their
I hope
balance in
not.
their portfolio.
I mean, we're a non-bank entity. And wholesalers are really jumping on board. I mean, you got the big ones, UWM and Rocket Mortgage, and there's several other ones out there that are basically saying, oh, yeah, you guys are going to just pick what you want over here. We're going to take all the rest, and we're going to build a huge clientele. And brokers are benefiting from that. Brokers are taking more, I believe, more piece of the pie, and for a very good reason, than they ever have.
Well, they always have, because the broker attitude was to go out and get the business, where the bank's attitude was the business come to us. We're a staple in the corner. We have a retail location. We have a fixed asset to come on into, and that's what their whole approach was, where the broker, well, where are you, man? We'll come to your house. We come to your job. We meet you in the parking lot. And that's been the biggest difference in building that business, that portfolio, years over years, and it's really paid dividends.
The last trend to pay attention to, rate lock in effect, but it's more lock-in effect. Lawrence Yun, he says across the board, there's nothing like having a low mortgage and seeing rates go up, and people are not really seeing the incentive to move. But as we see low interest rate environments stick around, I believe we're going to see more people say, you know what, we can now keep that low interest rate, sub-3 interest rate, and move it to another state, move it to another house, wherever that may be, and retain our interest rate. So I think we're going to see more and more people selling as they see these low interest rates, not just pushing up home prices, which we're going to get to. There's a very interesting article about what out-of-staters are doing to local markets. Very interesting. We'll come back after this break. I'm Tony Mendes. That's Gordon Hines. This is the Real Estate Report on AM 1220 KDOW. You can call the show 800-516-1220, 800-516-1220, or email the show, Tony or Gordon at BayAreaLoanSource.com. We'll be right back.
Phone lines are open on the Real Estate Report. 800-516-1220. That's 800-516-1220.
Going back to the Real Estate Report, I'm Tony Mendez.
And I'm the maestro, Gordon Hines.
Zillow says Case-Shiller's home price forecast is expected to decelerate. We had a 16.2% year over year in June. They expect to see that decelerate. We do too. I mean, we've been seeing a lot of. I just read a report about many realtors in places across the United States are expecting to see the 2021 to play out at 9% year over year price growth, and then whittle down to about 3%. But that's still positive growth, Gordon. Is 3%. Now, we've been spoiled seeing home prices go up double digits in many parts of the United States. In some places like Boise, which saw 22 or 25% year over year. Places like Utah, Salt Lake City, and Austin, which we're going to talk about a little bit later, seeing these 20% or more. Are we getting a little bit spoiled here, Gordon? Are people going to be a little bit less incentivized to get into real estate if they 3%? By the way, if you go do a rent versus buy calculator and you put 3% in as far as appreciation, it will almost tell you every single time you need to buy a house. Imagine putting 16.2% in. It would tell you to buy your house, like what? It'd probably say you're stupid to not buy a house. But 3% just puts you right off the chart as far as growth over like a 10, 15-year period. But we're so spoiled with these numbers. What do you think about 3%?
Well, the human being is a creature of habit. We're definitely spoiled. Just like
and we have short memory.
We're also spoiled with these low rates. If we're looking at 30-year fixes averaging less than 3% for the last 5 to 7 years, when rates start to go up, you call a person with a 3.25%, 3.5% rate, they think you're crazy simply because the benchmark that they're using to qualify or compare it to. So yeah, we are creatures of habit. So 3% is actually a good deal.
Pretty decent.
Depends on what you're comparing it to. In areas like where there's a higher much appreciation, then it's not that big of a deal.
Oh, do you need a tissue?
No.
You okay?
Yeah.
All right. So I agree. I mean, when I bought my first house, I didn't get into it for appreciation. I got it because I could buy a house, I could afford it, and I could live in it, and it just happened to go up. And real estate doesn't always go up. We saw what happened. It can go down a lot. We don't think it's going to do that same thing again. We think it's going to be more stagnant than anything once interest rates go up because there's still such a lack of inventory. And you go back into the 2006. Leading up to 2006, there was massive overbuilding. And then, with the overbuilding, the abundance of inventory that was out there, and then we had the snowball effect of selling because of foreclosures, and we had all those recastings of negam loans and so on, and that snowball effect. We don't have that anymore. We don't have a problem with it. We have a problem with inventory, which always creates a higher demand, and then we have better quality buyers. So I don't see it going. I would take 3%. I'm happy with that. I'm going to keep my house a little bit longer. Now, of course, that's just a projection. That's somebody's opinion. There's probably no real math on it, but I like 3%, Gordon. If you plug that number in, go to a rent versus buy calculator instead, and it'll ask you what appreciation you want in the house. I put 1%, and that still tells me to buy. But at 3%, it tells you to buy almost every time. Go try it out. We'll come back after this break. I'm Tony Mendis. That's Gordon Hines. If you need a good rent versus buy calculator, you can always email me, Tony@BayAreaLoanSource.com, Tony@BayAreaLoanSource.com. Again, call the show 800-516-1220. We'll come back after this break here on AM 1220 KDOW. This is the Real Estate Report.
Got a question? Run it past these guys.
800-516-1220.
It's the Real Estate Report with Tony Mendez and Gordon Hines on AM 1220 KDOW.
Welcome back to the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
And you can always call the show 800-516-1220, 800-516-1220, or shoot us an email, Tony or Gordon at BayAreaLoanSource.com. Early in the show, we were talking about some of the scenarios that people are using. It's not quite common knowledge until you actually talk to a loan agent or your realtor. Hopefully your realtor knows about the scenario. But we recently did a purchase transaction. Well, we didn't do a purchase a client of ours purchased a property and was looking to replenish that money. It's called delayed financing. We have Rob Black on today. It just happened to be Rob Black. Welcome in.
Hey, Tony. How are you? Gordon, hello.
Another great day. How are you?
So tell us about your transaction. You said it was one of the weirdest ones you've done and also one of the fastest.
You and I, Tony, have known each other for 25 plus years. Gordon and I have known each other for 10 plus years. And I just bought a house because my son needs a different school district. So we're moving from San Mateo to Marin. And I bought a house in cash. And then you asked me, do you want to get a loan on that house? I'm like, I can't. I just bought it in cash. And you just got me the best rate I've ever got, Tony and Gordon. Thank you. The system, the back-end system that you guys have, as far as technology goes, but how is this possible that I got a great rate after I bought with cash plus I'm stunned by the financing levels right now.
Well, believe it or not, this product's been around for a long time. It's called delayed financing, and it's meant exactly for what you did. And not a lot of realtors did either. I mean, imagine realtors running, a whole bunch of them, a large percentage of them running around saying, hey, by the way, if you buy this house in cash, you can call your broker and get delayed. You get some of your money back, almost all of it in some cases. Not all of it, but you still have to follow what they call cash out guidelines. So, of course, in your situation, you're not taking all of it back out. You're taking a smaller portion of it, and that helped the rate because you're taking a very low LTV, good credit score, all helps. But again, it's not a well-known product, Gordon, isn't it?
And the good thing is we didn't actually need an appraisal in this particular circumstance. So, I mean, everything worked in its benefit. You've got a super low rate. We didn't have to do an appraisal. This transaction was done in less than 15 days. Everything was above board, and I think he can actually benefit from the long-term ownership by replenishing, putting cash back in his pocket, less than 3% rate, which you can't borrow money that cheap. It's actually a good deal, a good program, and I think people should really, really look more into it than just take it as face value.
Yeah, and then you can look at you get your write-offs back, right? I'm assuming that's how it works. Obviously, contact your CPA, but if you were to just buy a house and then try to refinance it regularly, you have to wait 6 months to do it, to take the cash out, especially and then to use the higher value. If you want to use the higher value, some lenders go 12 months, but you can go 6 months and use the higher value. If you do a construction or renovation on your property, you can actually use the higher value if you document how much it costs. My house was worth $1 million before I did the construction. I just did $250,000 in renovations. My house is now worth 1.25 because you can now document exactly how much it costs. Otherwise, you have to wait the 6 months. So there's a lot of different little caveats
Nuances.
here that you can play around with. But it's important to know these things. Some people get into these transactions, Gordon. We talk about exit strategies all the time that get into transaction. They don't know how they're going to get their money back. They don't know how they're going to get refinanced. That's the worst thing anyone could ever do is go out and get like a private loan or a non-QM loan and then get stuck in it. They get stuck in that cycle. I'm paying 2 or 3 points. My interest rate's 7 or 8, 9%. And they keep in that cycle because they never got that exit strategy. We run into people like that all the time.
Yeah, we just did a transaction for a couple that was married. They got divorced. They sold the house, and the wife allowed the husband to make a cash offer for the next house they bought. And, of course, after he bought the house, he refinanced and took some of that cash out and gave it back to her. Of course, they have a good relationship, do something like that. But all these options are available. Most people don't realize these options are available. Doesn't cost a whole lot, especially if you can get an appraisal waiver. You don't have to do an appraisal. Transactions can close in a very short period of time. Rates are low. Everybody benefits, and take that money back to the bank.
You know, and you just mentioned something. You're like, oh, it can just close in a short period of time, and you can get the low interest rates. This is like a stock. Like if you're hearing about hey, that's a great. My friend just told me about a stock. By the time you hear it, it's already too late, right? You just told me about a stock today. I was like, okay, it might be too late. It's probably too late. Same thing with rates. If you're hearing about low interest rates and you haven't, at least started it, how many people are we working with right now are just sitting there waiting for rates to hit where they want it to be? There are some, and some people we convince them, say, look, this is the right day to do it, and they move forward. But if you haven't got in front of a loan officer in any fashion, checked your credit, looked at make sure that you can qualify, and you're ready to push that button, which, by the way, can happen quickly if you really pushed it. Not at the banks, unfortunately, but yeah, you can do it. When these rates present themselves, that's what Rob did in this case. He was able to say, you know what, rates have been dipping since March. This is starting to work out. I've already bought the house. I want to replenish the money, and we did it.
Yeah, great thing to put some of that money back in your pocket. Use that money to reinvest back into another facet that's going to give you a bigger rate of return than what the money actually costs. And we always talk on the show, if the benefit outweigh the cost of the money, then you should do it.
So I want to get to a quick email, and thanks for the call, Rob. Anybody wants to call the show, 800-516-1220, 800-516-1220. You can get your calls on the air. We had an email from an old client. He came back out and said, you know what, I got a bunch of equity in my house now. I now want to buy a piece of land and build a piece of property on it. But he started exploring, and you know this, I'm asking you this because you've done this many times. He was saying, well, why don't I just wait until I find the piece of land and then get the plans and just buy everything at once, get a construction loan and a land loan at the same time. But don't you want to own the land first so that you can get the plans? I mean, I wanted to respond to him and say, this is what you need to do first, is get the land. Yeah,
well, typically, you don't buy the cart before you buy the horse. I think if you you already made up his mind what he wants to do, the gentleman is on his game, so he wants to buy a piece of land, build a house, and probably live in it, right? So the first step, of course, in the transaction is purchasing the land. Once you purchase the land, of course, then you go through most people purchase the land in a cash position. If you own in a cash position, it's really easier to get a construction loan after that. It's much less costly. You can go out and get your plans and your permits and all those kind of things, and then you can go ahead and go out and apply for your construction loan to build that property. And once that construction is done, you can either get a takeout loan or you can refinance to replenish that cash or get a lower rate. But many different options out there once you buy in. Depends on your financial situation. Depends on how much money you make. Depends on your
well, that was the other part of the email too, is the qualification. And I didn't know this until I actually talked to the construction lender. You can buy properties. You'll love this one. You can build let's say you own the land. You can build a property using the future value of the property to set your loan to value. Okay.
That you can.
Now the land is already part of that. Okay. And you can build it as a rental and use 75% of the rents to offset the debt to help you qualify. So he now doesn't have to sell his house. He can just build it as a rental and then not move it into it until he refinances it. Maybe he does eventually move it and does it as a primary residence. But doesn't matter if he does it rental or not, the rates are going to be lower than the construction loan.
Well, I don't do a lot of construction loans, and I always tell people you learn something every day. We listen to the show, you learn something. Even me as a participant, as a co-host, just learn something. You can actually benefit from the rental portion of that future value of building the property. Never realized that, but learn something new every day.
And that's also the same so if you're buying a house and you're keeping your old house and you're moving into the new house, you can use the rents on your departing property to offset the debt to help you qualify. That's called the departing property rule. Lots of rules out there, Gordon. They aren't just clearly out there for people to find. You're welcome to shoot us an email, Tony or Gordon, at BayAreaLoanSource.com to get any kind of feedback on your questions, or you can call the show 800-516-1220. That's 800-516-1220. We'll come back after this break. I'm Tony Mendez. It's Gordon Hines, and this is the Real Estate Report.
Tony and Gordon are taking your calls at 800-516-1220. It's the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm the maestro, Gordon Hines.
Some of the other notes in the real estate mortgage business out there. Investor home purchases hit records, surpassing pre-pandemic levels. Investors took the housing market by storm in the second quarter, buying up $49 billion worth of homes as surging property prices and rental demand created opportunities for hefty profits. Multifamily properties remain the most popular among investors, but single-family homes and condos are still streaming along. Relative affordable metros in like Phoenix and Miami have jumped in popularity through the pandemic, and they're the top markets for investors. Number of homes purchased by investors, 67,943 in the second quarter of 2021, Gordon, an all-time record. Can you see this actually panning out with higher home prices, and investors are still jumping in, and people are sitting on the sidelines wondering if home prices are going to keep going up? I mean, investors keep seeing real estate as a pretty darn good investment.
Yeah, absolutely. I mean, investors, what they do, they create a need for property. Investor takes an ugly duckling and turn it into a diamond. So when you look at properties that are bought, rehab, and sold, I mean, that's create energy. People love to walk into a house and love all the antics and all the stuff they have in it, turnkey, and not have to deal with construction. But that's what the investor did. He have turned that property that people turn their nose up into something now that's also attractive. So that's part of the marketplace. This is the reason why you're seeing investors have done so well over the past 3 years or so in the real estate market.
Meanwhile, the big, what they call institutional investors, are still picking up big chunks of properties across the United States. One seller, he had 15 single family homes, and you have this moratorium coming due where the what does it call it, the rent vacancies, the eviction moratorium, that's ending. But during that time, this one investor with 15 properties, he had to sell out to a big corporate investor. So you have these are companies that buy over 1,000 homes, and those things are really booming right now. That doesn't really lend to putting inventory back in the market. In fact, I just saw a report about how home ownership now is actually dropping. This is one of the reasons. This is contributing to those numbers. And then on the other end of this, Gordon, I like this story, like Jay-Z and Will Smith. They're investing in a company to help low-income folks that go from renting to buying. So what they're doing is they're raising money to go out and buy thousands of homes, or as many as they can, okay? And they're going to turn those into rentals. But the people who rent also sign an agreement, and they lock in a price that as soon as they qualify to buy that house at that locked-in price, they buy the house. So you have kind of two ends here. You have this kind of bad plan of, where like California's banned these kind of investors coming in and buying big blocks of houses, yet they're still doing it. And you have one end of the spectrum, and then you have people that are coming out. And I love this story about Jay-Z and Will Smith saying, we need to help some folks get some homes here.
Well, the biggest challenge for most people here across the country, especially here in the Bay Area, is affordable housing. And we always talk about there's no way we're going to get affordable housing unless you get some type of government participation. Of course, these guys that are financially solvent can make those leaps and fill that gap if they can go out and buy some homes and sell them. I think there's another company I think locally was doing that. I think Wayfair. They bought blocks of homes after the financial crisis back in 2008, 2009, what they call rent to own. People bought those homes, and now later on they get first right refusal to buying those properties at set prices. It's a win-win situation for people that are renting to owning rather than renting. So I think it's a great concept. I think that can really probably narrow the gap in the fact when it comes to affordable properties.
I'd like to see big companies get in this as well. Listen to this. The company purchases houses and rents it to the client until they qualify. The client can buy it back at a predetermined price up to 2 years after the initial acquisition. As part of its service, Landis, it's called Landis Technologies, provides coaching for clients on how to manage their finances and to improve their credit and save money that they need for the down payment. They said rent's equivalent to its carrying costs on the home. It also charges a fee on top of the value of the property at the time of the initial purchase. And if a client isn't ready to buy the home after 2 years, they offer them more time or they sell the property. So I like programs like this, and maybe this sets a precedent for other investors or other startup companies to get involved in this.
Programs like that are great. Of course, there can be glitches along with the program. The buyer is not prepared to buy in 2 years. The buyer, of course, doesn't want to move. It creates a problem. Anything can happen. But I think if the property is well thought out, there's a formula in place. I think if there's some type of government law that go along with that, so they can continue to keep moving the markets, I think this is a great thing. We really need more affordable housing. Affordable housing is suffering in the area. People are outpriced by affordable housing. That's what we talked about on the show before about minimum wage around the country. It can no longer sustain a minimum cost of a 2-bedroom rent across the country. So, of course, if that's a problem just from a rent standpoint, could you imagine what it is from a homeowner standpoint?
Yeah, some people shouldn't own homes. There's no doubt about that. So we peaked at 67% home ownership. It's down. I believe it's 61. I can't remember the exact number. So it's going up and down. But investors, you look at those numbers about how investors are really jumping in, and that's not leaving a lot of affordable housing left for people, especially when these people the investors have pockets and pockets of money, Gordon. And it's been one last story. Maybe not. We don't have enough time, but this is an interesting story about how out-of-towners are buying properties across the United States. And like, for example, Austin, which hit the top of this chart, 7.8% above asking price versus 7.3% above asking price for locals. So out-of-towners are spending almost twice as much in Austin and driving up prices. I think we're going to continue seeing places like Austin and across the United States in these smaller cities, more affordable cities, continue to see price increases faster than we see in other larger metropolitan areas. With that said, thanks for joining us today. I'm Tony Mendis at Gordon Hines. You can always reach us at BayAreaLoanSource.com, or you can email us, Tony or Gordon, at BayAreaLoanSource.com. We'd be glad to get any of your questions on the air or answer any of your scenarios, give you any quotes you need. We'll come back next week. Thanks for joining us. And last comment?
See you next Thursday.
See you next Thursday.